let's look at the facts. Now, the June NFP report just came in soft, well below expectations, obviously well below previous. But most of all, what happened here is a notable revision of the previous two NFP releases. So the labor market side of the Federal Reserve mandate just got quite a little softer, okay? In fact, the dollar sold off, yields sold off, and interest rate expectations for the Federal Reserve also started to unwind. Now, here's where it gets really interesting, because if we look closely, there are roughly 20 basis point worth of hikes, worth of Fed tightening priced in for the year. Now, you don't need a fancy software to see this. You can just pull it up for free on TradingView just by searching for global rates expectations in the indicators list. Now, what this means in plain English is that the market hasn't completely let go of that potential rate hike, despite obviously the soft NFP. It's still holding on to about 80% chance of a potential rate hike this year. And this is what makes the setup on the dollar interesting and an opportunity, because by understanding how interest rate expectations relate to the dollar, you see where this gets really interesting, because as you can see from the chart, the dollar, in this case the dollar index, is pretty much almost fully correlated at this moment in time with what's priced in for the Federal Reserve ahead. If the market expects the Federal Reserve to hike interest rates, the dollar strengthens, okay? If the Federal Reserve instead is expected to maybe not hike interest rates, potentially at some point maybe even cut interest rate, but that's not a story for much later on. For now, it's about how much is going to hike, are they going to hike? If things move in a hawkish direction, so more rate hikes, the dollar strengthens, less rate hikes, the dollar weakens. Now, understanding this is how you get ahead of the curve. So let me actually repeat this for a second. If people think that the Federal Reserve is going to hike rates once, twice, maybe 3 times, whatever it is, the dollar gets stronger. You can see that on the chart right here. If they think that the Fed is not going to hike, maybe they're going to hike less, from 2 rate hikes to maybe 1 to maybe 0 rate hikes, well, that's when the dollar weakens. The relation is that, okay, they are the same things. So that means if you understand where interest rate expectations are going to move, you understand how the dollar is going to move. See what I mean here? Now, that's a much more realistic question to answer than trying to answer within the chart itself. At least for me, to be honest, I can know how rates will likely move based on the macro context, because the framework is simple. The Federal Reserve just not comes out and say we're going to hike or we're going to cut at random. They react to data, the same data that you and I can look at. Labor market, inflation, and so on and so forth. I'm going to get to this in a minute. Now, by understanding the context, we can understand how the Fed is going to move. And if we understand how the Fed is going to move, we understand how the dollar is also going to move. So follow the logic here. The 2 main economic data points that drive this whole narrative are the 2 points that make the central bank mandate: inflation and labor market. You don't have to track countless indicators. You have to track inflation and labor market. Now, we've seen the NFP today with the labor market, which has weakened, that's softened, okay? Not just this NFP, but we also saw the softening on the previous 2 NFP, which have been downgraded, revised lower. So what is the one thing that is actually missing to actually fully understand whether the Federal Reserve is going to hike in the next 2 meetings or not? It's the upcoming inflation print, the CPI print. Now, this is due on July 14, but remember, always remember market movement expectations. So bear with me, because this is where it starts to get really, really serious, because that brings us to the piece of the puzzle that matters most, okay? We understand that the next big variable is inflation, the CPI. Okay, now, why has inflation been so stubborn lately? Well, a massive part of the story has been energy prices, oil prices. Oil prices spiked higher, obviously, because of the geopolitical saga that happened with Iran, obviously, at the start of March. That fear and that situation with the Strait of Hormuz directly fed into headline inflation. Now, here you're seeing, to make it simple, we're seeing crude oil in candlestick, and we're seeing headline CPI in the orange line. Okay, you can see crude oil prices lead headline CPI because energy prices are a big factor, a big component of headline inflation. So what happens? Being that inflation comes out, let's say in July, and it covers the June month, well, obviously oil prices in June are going to impact how inflation is going to look in July. So look at what happened here. Oil has moved all the way back pretty much to pre-Iran levels. The geopolitical premium has faded in oil. It's back around the 60s. And logically what that means? Well, it means that inflation, especially headline CPI, is most likely going to come lower as well in the coming months. So the single reason that could keep the Federal Reserve hawkish, it's now fading. We've seen the labor market is softening, and now if we look ahead, and this is what I want you to do when you do fundamental analysis, you don't have to look at what's happened. I want you to look at what's going to happen next. Okay, in this case, oil prices, energy prices are telling us that inflation is most likely going to come down next. So you can see the picture being painted here. The soft NFP reduces the argument that the labor market is exceptionally well. Well, it's not bad, obviously. A 57K NFP number is not too bad, but it's not great either. Okay, it was expected to be much better. So there is some softening in the labor market. So this reduces the labor market is great argument, okay? Now, on the opposite side, inflation is doing something else. Oil prices are moving lower, which reduce the inflation pressure argument. So over the next couple of weeks, in my opinion, the dollar is vulnerable to weakness. Why? I'm going to try to simplify as much as possible. And if it doesn't make sense, let me know in the comments below. I'll try to articulate it in much simpler. But you can see on the chart right here, again, we're looking at the interest rate expectations for the Federal Reserve in blue, and in candlesticks, we're looking at the dollar index. You can see the exact same type of correlation movement. If interest rate expectations move higher, so rate hikes in this case, the dollar strengthens. If interest rate expectations start to move lower, the dollar weakens as well. Now, the whole point here is that we can understand, we can analyze from a macroeconomic point of view. We can analyze the context, we can analyze oil prices, we can analyze inflation, energy prices, we can analyze things to understand how the next inflation point is most likely going to unfold. And based on that, we can understand, is the Federal Reserve actually going to need to hike interest rates? The labor market is starting to say, hey, maybe rate hikes are not a good idea. Oil prices are starting to say, hey, inflation is about to come down. Rate hikes are not that much of a good idea. So these 20 basis point hikes, what is the path of least resistance for these 20 basis point hikes? Well, it's lower. It's most likely that the Federal Reserve is not going to hike rates than it is. So what happens to the dollar if interest rate expectations move lower? Well, the dollar as well moves lower because their correlation is unquestionable. So the evidences are starting to stack up against the dollar, soft labor market, and potentially soft inflation ahead. Now, you're gonna say, well, okay, but inflation is 2 weeks away. Golden rule of fundamentals. Markets move on expectations. By the time the next CPI actually prints on July 14, 2 weeks from now, most of this move might actually be done already. It might have been played out already because the market moves on expectations, and oil prices are strongly saying that headline inflation is going to come soft ahead. Now, the Federal Reserve cares more about core inflation, yes, but headline inflation is going to move the needle as well, okay? And core inflation tends to some extent, obviously, be determined as well by energy prices. The whole point here is that by the time it becomes too obvious, by the time the CPI actually prints, most of this move might have already been done. So what I'm saying here is that you might not want to miss this trade on the dollar because it's probably going to set up way ahead of the next CPI. And when the CPI prints, we're gonna get probably the extra leg of dollar weakness. But to make the whole point simpler, if the market, and in my opinion, it will, because there's no reason at this moment in time to actually expect the Federal Reserve to hike interest rates. Well, if interest rate expectations will move lower, as I expect, a fair bit of pricing is maybe 10 basis points, maybe 5 basis points. I mean, a little bit of a premium in interest rate expectations is acceptable, but not 20 basis points. 20 basis points is the 80% chance of an interest rate hike. That's a lot for the context we're in right now. So the dollar, what it will do, it will follow interest rate expectations. If the Fed hikes, dollar strengthens. If the Fed does not hike, dollar will weaken. And the context right now is saying, hey, the Federal Reserve is probably most likely not going to hike. This is how you get the next leg lower in the dollar. And this is fundamental analysis in real time. Now, if you like this type of in-depth analysis in real time, let me know with a like on the video and subscribe if you haven't yet.